We're going to kick things off this hour by talking about relief efforts for small businesses in America. The attention so far has been focused on the government's $350 billion Paycheck Protection Program. Meantime, the Federal Reserve has its own potentially much larger program in the works, but it's facing some unique obstacles before it can get off the ground. And for that, we want to get to Steve Liesman, who joins us with more on that story. Mr. Liesman, good morning.
Andrew, good morning. Yeah, the Federal Reserve is making this so-called Main Street lending facility a top priority, and it's hard at work at it. And this is, as you say, could be much bigger than this $350 billion Small Business Administration program. It could be as big as $4 to $5 trillion, using $450 billion to lever it up from the Treasury. It's already, we understand, working with the private sector. And we could get some answers about how it's going to be structured as soon as 7 to 10 days, according to one source. But there are numerous issues for the Federal Reserve to deal with in putting together a facility like this, which is so different from what it normally does. For example, in the CARES Act, it says that for a period of time that businesses receive these loans, it can't be engaged in share buybacks or dividends. Company has to be U.S. based, so there's some ownership tests that have to be gone through there. There are certain compensation restrictions that appear, as far as I can tell, that would apply to the Main Street lending facility. And of course, there's this conflict companies. In other words, there can't be loans to administration officials or members of Congress. Now, these are issues that, other issues, though, that cut to the heart of what the Fed is, how it's restricted and what it could do, and how it would structure this facilities. For example, Federal Reserve is not really supposed to take losses, so it has to protect itself in that way. At the same time, it has to incentivize banks to loan and borrowers to borrow, so it can't set the terms of the loan in such an onerous way that nobody really wants to take it up, with a question about whether these are recourse loans or non-recourse loans, which is what they have in the SBA program. In addition, it has to provide liquidity, but can't really back up a failing institution. That's one of the rules in the Fed's Emergency Powers Act. Talked to Krishna Guha from Evercore ISI. He used to be at the New York Fed during the crisis, helped create some of the old programs. He says it's going to be very challenging for the Fed to design and implement a Main Street lending facility that's going to be impactful. Now, he's not saying it can't be done, but he says it's just so much easier for the Fed to operate in capital markets than it is to operate in this sort of way here. One of the dilemmas, Becky, here is, should companies like oil companies be eligible, or retail companies, and how the Fed distinguishes between the difficulties it had previously versus the difficulties created by the coronavirus. Becky?
That is a lot to process, and it leads to a lot of questions, Steve. But I guess the one I'd ask first is, what happens here? Who's liable for these loans if they go bad? Is it the bank that made it? What happens if the lenders don't pay? What happens if they just don't meet the requirements that have been laid out and they give a loan to somebody outside of those parameters?
TBD, Becky, is my understanding. It's going to have to figure all of that out. Fed's going to need the banks to be the front line on this. Also, my understanding is it will use the regional district banks, St. Louis, Kansas City, Dallas, New York, to really oversee some of this thing. But one way to think about it is a haircut. I know we're all thinking about haircuts these days, given that we're stuck at home here. But what the Fed could do is haircut a loan. Say a business goes to the Fed with $100,000 worth of inventory. The way you haircut that is the Fed could loan 70% of that. In other words, give a loan of $70,000. And I'm just making up that haircut there, depending upon what it is. And then the Treasury would protect it another 10%. So these things are going to be carefully structured so the Fed doesn't incur losses. At the same time, it needs to provide an incentive for people to borrow and get this money out into the economy.